Hey everyone, welcome to the program. This next interview, we're going to talk with William Lieberman, who I've known for a while. He's a good friend, and he kind of has it all. He's been an entrepreneur. He's founded a company. He knows what it's like to go through the early stage process. And the unique thing about William is in those companies, he has always played the CFO role. So he has a heavy background in finance and financial analytics. And today we're going to talk to him about his experience both as an entrepreneur and running a company, but also in his current role, which is as the founder of the CEO's Right Hand. And what he does is work with early stage companies, helping them understand how their financials are going to help them strategically grow their business. So he works with companies both in the fundraising side, debt side, helping them understand the differences between the two and how to basically make the investment cases using clear, sound, defensible financial models. So with that, let's go talk to William. All right.
Let's make it happen.
All right. So welcome everyone. Today I'm here with William Lieberman, and we are going to talk a little bit about these questions around funding and early stage company growth. William, I've done a little bit of an intro so people have a sense of kind of your professional background, but I'm wondering if you can give a little more details just on the story of what you've done in the past, how you've gotten here today, just to give people a little flavor and a little history.
Sure. I've always had a background in both technology and finance.
Mm-hmm.
So I started my own company way back in college in the software business and went back to grad school, both for an MBA and a master's in computer science. So I've always had a leg in both finance and technology, and I started my own business and my own software company, grew that up to about 10 million in revenue. And as part of that, I was always the CFO. We had other people doing other areas, but I was the de facto CFO. We didn't need another person to come in and do that role. So I played that role throughout the life stages of that company. And then recently, about 2 years ago, I left that for a startup, which didn't start, and along the way formed my own boutique consulting firm. So I've been doing financial consulting for about a year and a half, 2 years for a variety of companies at a variety of stages, all growth company, all early stage growth companies.
Oh, that's great. So you have both kind of an intimate knowledge of the finances in terms of what the kind of financial situation is in terms of early stage startups, early stage companies, and how kind of funding plays into that, but also from an actual founder, CEO, entrepreneur role itself as well.
Exactly. And when I'm working with startup companies or early stage companies, it helps them to know that I've sort of stepped on the landmines, and so I can point out which ones to avoid for them. And that happens in the financing area as well. So it's definitely helpful to have been there, done that.
Good. So, most of our audience here are key executives, entrepreneurs, founders, CEOs of these early stage companies that have, some level of growth potential. And I think a lot of what we're trying to do is help them just kind of understand the landscape a little bit better in terms of when we talk about raising capital for sort of growth purposes, what are kind of the options or the different strategies that are out there, or at least people should be considering when they start to go down this path?
Sure. I think most importantly, before you even get to which are the vehicles or which are the options, is learning how much or understanding how much we actually need.
Yeah.
Right. So how much capital do we actually need to raise at this point in time to give us this much runway? And for that, how much do I need to give up in terms of equity to the investors? And that's very important. You have to understand, to have a clear understanding of exactly what the capital is used for and how long is it going to take, or how long will that give you in terms of runway. So that's the first step. And we spend a lot of time with people really on digging into that, because that drives the rest of the process. From there, it's kind of, it all depends. So there is a panoply of options out there. From crowdfunding to angels and high net worth and groups of angels to seed venture capital firms that look at seed investments, and there's a number of those out there, to strategic investors. that are in your space that have an interest in helping start something or working with companies that are in early stage possibilities. So there's a variety of options available to early stage growth companies in terms of financing, and it all depends again on what you're looking for, what types of needs that you have as you go out for that funding.
Great. So I even want to take maybe even a step back from that of just kind of understanding. I think a lot of people, when they get into this, well, I need capital to grow my business, immediately go towards this, well, I've got to do some kind of equity kind of situation. And one thing I have found is that not all companies are really fundable from an equity point of view. And how would you kind of characterize those companies that are most likely or should be considering some kind of capital for equity arrangement versus other kind of arrangements that would give them fuel for growing, what is a potentially investable business, but from an equity point of view may not be as attractive for investors?
Yeah, so when you look at equity versus, let's say, debt, right?
Mm-hmm.
So when you look at equity versus debt financing, it really does depend on the traction that you've had, mm-hmm. the market potential that you have, the team that you have in place. Have they done this before? Have they had an exit before? So the more boxes that you can check, the easier will be to get an equity investor interested. So those are the types of things that are very important when you're looking at an equity raise. So that gives you sort of a flavor for the types of things that an equity investor is looking at. And if you don't have that, then by default, you have to go after an alternate vehicle as in debt.
Yeah. Any key things that, we kind of did this checkbox hand gesture. Like what's on that list for you? Or what are a couple of things that you think are particularly important when a company is pondering or considering some kind of actually either debt or equity, that they should think about, get in order, what's on your list?
Right. Well, first and foremost, if you're looking at debt, which is going to be an easier conversation, debt, the investors are looking at cash flow. So are you generating cash flow? How much? Do you have enough to service the debt? If it's a bank facility, you're going to be looking at covenants, which just is basically how much debt you have versus, or how much cash flow that you have versus the interest payments that you have to make, so that the bank knows that they're going to be repaid. Mm-hmm. In addition, on the debt side, what security are you bringing to the table, either in the company or personally, so that you can secure that loan to the lender? And that's going to be, God forbid something bad happens, how are they going to get repaid? So that's on the debt side. Those are two very important things. On the equity side, the types of things that people are looking for. So again, it's back to the team, because people invest in people. So yes, you could have if you have a great idea and a mediocre team, you're not going to get anywhere. If you have a great team, they can adjust their idea to make it a great idea, because that's what makes them a great team. Yeah. So that's first and foremost the thing that equity people are going to look for, equity investors are going to look for, is the team. And part of that is, what experience do they bring to the table, and have they done this before? Have they exited before? Then you get into market potential. What is the market size of your product or service? So, if it's a VC type investor, it's going to be $1 billion or more kind of thing. There's going to be lots of companies that don't have $1 billion total market potential, but still are going to be are fundable. You just have to look at alternate ways. You're not going to the traditional venture capitalists to do that. Okay. Other than that, it's what traction do you have? If you're a software company, have you built something? Do you have a prototype? Do you have customers? Do you have any revenues? And if so, what's the growth path of those revenues? So if you're showing good traction in terms of building the business, that's another box that people are going to look for. Do you have defensible intellectual property? So do you have something that's patentable, or do you have trademarks in place? Do you have some secret sauce that you've developed for your product or service that prevents competitors from coming into your space or taking away market share? Do you have advisors on your board of advisors, board of directors? Do you have other people around you that can add value over and above, hands-on doing something like a management team member that brings value to the business as well?
Yeah.
Those are the types of things, and there's several others.
Okay. So say I'm a founder, owner of an early stage company, and I haven't done a whole lot of work or a whole lot of thinking about this, and I'm realizing that I could get a lot farther, a lot faster with an investment. Are there some sort of general outlines of the steps that I can expect to go through over what period of time? I mean, just kind of what should we be setting these folks in terms of their expectation, in terms of what the timeframes are, and what the process looks like in terms of raising money in this way?
Right. So the process is pretty straightforward in terms of the steps. Mm-hmm. The timing depends upon who you're talking to and who you're pitching and the types of money that you're raising. So let's go through the steps. So you have to have a detailed financial model. So you have to understand, obviously, your business model, but you have to translate your business model into a financial model so that an investor can understand how are you actually driving revenue, right? So what products are you selling, what services are you selling, and what does that look like over time for the next 3 years, 4 years, 5 years, so that they understand the trajectory and they understand at the end, let's say 5 years out, how are they going to get liquid, right? Yeah. So if you're looking at an equity investor, first thing is, how am I going to get my money back? And I want 10 times on my money. If it's a traditional VC, how is that going to happen? And so you need to have a model that you really understand that is defensible, right? So everyone puts together models, and it's always this hockey stick. But if you have a model that people can understand easily, and you can translate into, yes, this is why I can sell 5,000 widgets per month 3 years from now, that's super important. And you have to be able to understand those types of questions. So anyway, building that model, number one thing, so that you understand what the business is and you can explain it, and that drives how much capital you need and when. Yeah. So that's step number one. Step number two is then you start understanding, who am I going after? How am I going to raise money? Is it debt? Is it equity? So what types of money do I need to go after and how much? Because then that derives the process for raising capital from there on. So if you need $5 million to really launch this business, that's a whole different path than if you need 500,000. Because if 500,000, you can go after friends and family, people that know you, that respect you, that trust you, and let's say you get $25,000 from 5 or 10 of those, then you can potentially start things rolling and then go after maybe a seed venture capital firm or maybe a group of angels or something like that. So putting together the what I call a capital raise roadmap starts with that model, then figures out how much do we need, then you figure out, okay, who am I going after? Then once you know that, it's putting together the presentation materials, which is an executive summary, a simple PowerPoint, 12, 15 slides, that's it, not a lot of text, something that you can really talk through and be passionate about, right? So people are going to want to feel that passion when you're talking to them for the first time. So you need to be able to get that across as well as part of your pitch. Then from there, it's what are the terms? So you need to understand, what's the price that I'm raising capital at? What am I willing to walk away from? And how much am I willing to give up? And then from there, there's going to be some sort of due diligence. If you're looking at friends and family, it's going to be very easy, very light. If you're looking at a venture capitalist, it's going to be more intense. And a bank, if you're looking at debt, will be somewhat in between.
Yeah. It seems like the big thing that I find with a lot of these early stage companies is really that question that you raised there, is how am I going to exit? And if there is no real clear strategy, and honestly, in some companies, no real possibility. I mean, there's some types of companies, some business models where there is no, clear, clean exit strategy on it. it makes it much more difficult in terms of raising, particularly around equity, because investors want to know, how am I going to get my money back?
Right.
And in terms of the model, I think a lot of people end up being kind of shocked. It's like how much they want in terms of return. That they're looking for, at 10 times, 15 times over 5 years. And when people start crunching the numbers, they get a little freaked out that, like, why am I paying this much? Why is there such a return on these things? And so it's part of this is kind of coming to grips with the inherent nature of a business and the risk involved in investment. And how investors, investment is a business as well. And in order to make that business work, they're taking a lot of high risk investments and getting a couple of winners over a large portfolio, and those winners pay for all the losses. So it's kind of just really understanding that investment is a business and how your company is going to play into that.
Right.
And when there's no seeing if you can come up with that exit and seeing if you can come up with those returns, and if not, going to some of these other strategies, particularly around the debt, or at least some kind of blended mezzanine kind of approach where there's some kind of there's less risk on the table, and from the company owner point of view, you have more limited capital, but the benefit is that you have a lot more control over it, and you're giving up less equity, and you're actually getting it. You have access to it. Let's talk a little bit about the model itself, because I think that's one thing that I've seen companies struggle with, is the difference between kind of an operational financial model, kind of reporting model for the purposes of managing and running the business, versus an investment model. And what's the difference between those, or what are the different questions that you kind of ask, and how do you deal with, I think a lot of people struggle with this, is I have no clue what's going to happen, and I don't have no clue what happened in 5 years. I have no clue what's going to happen in 3 years. I may not even know what's going to happen by the end of the year. So how do I actually have an intelligent conversation with a group of investors that's potentially a 5-year out plan?
Right. And you're absolutely right. There's a lot of work that's done by small companies that explain what's happened, right? So here are my books, here's my accounting report, or here's my P&L, here's my balance sheet. So I got this amount of money in the bank, I'm doing great. But there's very little work done that really is prospective. How am I going to do? How am I trending? Where's the business headed? How am I going to get there? How am I going to leverage my balance sheet to get me there? So that's a real art and very difficult to do. But what you can do is really think about the business that you're in and what you're selling to whom for how much money, and how are you getting to them, right? So it's the entire strategy of your business, but just boiled down into a spreadsheet. So for example, if you're selling widgets and your market is the United States, there's a variety of ways. You can sell widgets via e-commerce, you can sell a wholesale channel, retail channel. So you can build out a model that says, okay, well, if I'm selling on e-commerce, here's how I'm selling it, here's how much it costs. So month by month, how am I going to increase my sales? Well, I'm going to buy more Google AdWords, or I'm going to do XYZ on Bing. So you can do a lot of things to think about, how am I going to increase my sales over time, and what are the drivers for that business model? So when you think about e-commerce, it's how much am I spending online, how am I driving traffic, etc. And then that drives the expense side, and from that you can build out the revenue side. So you think about month by month, and then that just translates into year by year, so that you can really drive that business model. And then the same thing on let's say a retail perspective or wholesale perspective. How many stores am I in? How am I going to reach them? Do I need inside salespeople, outside salespeople? What's my marketing budget? So again, you think about the drivers for your revenue line by revenue line. And then that is how you build out that model. And you start, look, you're right, 5 years is a long time. So if you just think about the next 12 months as a starting point, then you can go month by month, and then it starts to get into a flow. And from there, you could say, okay, I'm going to do the next 12 months, and then I'm going to do annual from then on, because I'm going to do some just broad-based assumptions. And again, it goes back to having defensible numbers. So when you're talking to an investor, they're going to say, well, how did you come up with a penetration rate of 4.2%? Well, okay, so I'm going to do this, this, and this, and that's going to drive this much traffic, and that's going to get me this many clicks, and my click-through rate is this because based on my history, and you can actually have an intelligent conversation that defends your business model that you put together. But having said that, a month from now, that model is going to change. It's going to change again and change again. It's a living document.
Yeah. And the other thing I find is for many situations, it's really the list of assumptions that become the discussion points. I mean, you can kind of do these numbers and you can create these hockey sticks and you can have this net present value number in there, but it's really going through the assumptions that end up being the conversation with the investor. And if you can have that defensible set of assumptions and conversation where you basically convince an investor that these are reasonable and they're reasonable enough to generate some possibility of a return to get that money, that's really the intent. And I think that's sometimes a challenge for the business, but particularly the fairly sort of analytical folk that get very tied up in the model itself. I'd rather being the model is a tool for having a conversation that is trying to get an investment in place.
Absolutely. We always talk about the knobs and dials.
Yeah.
So what are the knobs that you can turn on your business? And that's what we build on our sort of assumptions page, as you call it, so that people can do a sensitivity analysis. So what if my click rate were 2% instead of 1%? Well, what does that do and how does that work, et cetera? And I've even had conversations with investors where I interactively work the model. And they go, oh, what if you hired 3 more people? Yep. How could I get more revenues out of it? How can I really tweak this? And then by so doing, the investor actually does their due diligence on your thinking as well as the actual model that's been built.
Yeah, actually, that's a brilliant strategy just from a psychological point of view. It now gets them enrolled kind of in the process and involved in the process and co-creating this outcome. The other thing I like about it, or I think that it brings up, is just this idea that at the end of the day, there needs to be some kind of story of how you're going to use the money. Because, I mean, like, okay, I can go out and ask for $1 million, but if I don't actually have a plan, and I think this was both for the investor, but also for yourself, if you don't really know how you're going to use the money is not that valuable. Like, you really need a plan, and you need to show where the money is going to go, how that money fits into the model, and how, like you said, reallocating or increasing that model. An investor may come back saying, well, I know you're asking for $1 million. You really need 2 to make this thing work, so we're going to put 2 on the table. It's that kind of conversation that ends up being one that I think ultimately leads in good, positive, successful investments.
And a lot of times what will happen is an investor will say, hey, look, looks like you need $1.5 million. I'll give you $500,000 today. If you hit these 3 milestones, 3 months from now, 6 months from now, I'll give you another $500,000. If you hit the next set of milestones, I'll give you the next $500,000. And so they set milestone-based investment tranches, if you will.
Yep.
And what you can do as the entrepreneur owner is you can say, okay, great, I'll do it that way, but the second one's going to be at a higher valuation, and then the next one's going to be at a higher valuation. So therefore, you're giving up as an owner less % of your company by doing so.
Yeah.
And it works. So it works for both sides.
Yeah, I think that's another concept that people sort of just getting into this haven't quite figured out, or often kind of get surprised by, or figure out as they go, which is as you show success, the valuation of your company changes, so therefore a fixed investment amount will warrant a different percentage level. And the more, the longer you can wait to actually take on investment, and the more progress that you can show during that time, the less you're going to have to give up. So if I, day one, no revenues, no customers, look for $100,000, I'm going to have to give up a lot, versus if I'm already generating $100,000 a month in revenue and $15,000 a month in profit, I'm going to have to give up a much smaller portion of my company to get that same amount of money. So there's a certain argument of taking, just enough that you need to get to the next level and to get to the next point where you can go out and raise money at a lower cost.
Absolutely. And this is, the whole concept of bootstrapping your company is really all about that, is how to give up the least amount that you can, but still grow your business successfully. And in some cases, that means, back to your concept or your question about debt versus equity, if you take on debt, which can be risky because you have to come up with those interest payments and you have to repay the debt at some point, you don't have to give up ownership of your company. And that's a trade-off because, lots of early stage companies don't have that cash flow or want to use that cash flow to invest in working capital in the business, not towards interest payments and things like that. So if you can put off, as you say, and make progress, you'll end up with much more of the company at the end of the day.
Great. So I just wanted to take maybe one last question, which is, look, I know, but it sounds like you've worked at a lot of these different types of companies. Based on situations that you've seen, what are some of the or what's kind of one big thing to avoid or thing to keep in mind, piece of advice you could give to someone kind of in this process, beginning to think about it? The one thing they can do now that might save them a lot of pain going forward. Anything that comes to mind in terms of nightmares that you've seen that you could try to help some people avoid?
Well, for sure, having all your books in order, which means not just your financial records, but all the records of the company, so your contracts, your intellectual property. The more that you have organized and easy to find, easy to put your hands on, easy to give to somebody, the faster the process will go. Because one of the big things is people always say, oh, I can raise money and it'll take me a month or two. And, it never does. It always takes a lot longer than anyone expects. For a variety of reasons. I've seen every excuse or every situation known to man, from literally people getting pregnant and going out on maternity leave to vacations to somebody. I was working with a client and the investor died, like in the middle, like we had a term sheet.
No.
Investor died and investment went away. So you have to go down multiple paths. And have multiple options so that you have not just plan A, but plan B and even C and maybe D, so that you know how you're going to get from here to there no matter what. And that's what I've seen. Entrepreneurs that are really determined and really dedicated, they will get there no matter what. And those are the ones that really are successful.
That's great. So this was great. A lot of great insight, a lot of great ideas, great advice. How, if people are interested in getting more information about what you do and how you might be able to help them, how do they get in touch with you? What's the best way?
So my website, the CEOsRightHand.co. So THECEOSRIGHTHAND.co. That's the best way, and I have information out there. And of course, give me a call, 646-277-8728. And I'll always be available. And I'd love to talk with folks that are interested in learning more and see if we can help them.
Any particular type of companies that you focus on, or particular type of company that should contact you?
No, I actually have a pretty broad base of clients and geographies, right? So I can work with people no matter where they're located. Days of Skype and internet allow us to work virtually. I love to work with, or I really only work with, companies that are growing, companies that are passionate about growing, right? I'm not really interested or working with people that are just, I got $1 million business, I'm having my $1 million business and that's it. Okay, fine. But if you really are interested in growing your company, that's what I'm excited about, because I get excited when you're excited.
Yeah, great. Thank you so much, William. And for everyone, I'll make sure that all of that information is just below the video here, so you can click through in terms of contact information, email address, phone number, website, etc. It was an absolute pleasure, and thank you so much for being part of this.
All right, thanks, Bruce.
Take care.